Hi everyone, thanks for joining our webinar today. My name is Iqbal Branch and I head up marketing and product strategy for OptionsCity. As you may know, OptionsCity's mission is to simplify the way clients think about and utilize trading technology. We've been in this space for 9 years now and have offices here in Chicago as well as New York and London. OptionsCity has taken a hybrid approach to software development spanning the spectrum between buy and build, allowing custom solutions and buying an off-the-shelf solution. We believe this allows clients to have a quicker time to deployment while still maintaining the custom functionality that they require. OptionsCity is the leader in the options on futures software space across major asset classes with two core product offerings. We offer City Trader, which is a web-based platform for professional traders interested in trading futures and options on futures. We also have our flagship product, Metro. Metro is largely focused on market makers, proprietary trading firms, and institutional traders. The presentation today is geared towards users of our Metro platform. Today we are excited to talk about Metro and SPX Options. I have joining me today Pat Gardner, Business Development at OptionsCity, and Russell Rhoads, Director of Education at CBOE. We expect the webinar to last 30 to 40 minutes, and we'll leave plenty of time to answer your questions, which you can submit through GoToWebinar. With that, I'm going to turn it over to Russell.
As I said, my name is Russell Rhoads. I'm Director of Education at the Options Institute at CBOE. And before we get, as always, we need to take a look at the disclosure. I'm here for education purposes only. I am going to talk about a couple of trades I came across in the SPX using SPX Wednesday Weeklys, which is what we're going to talk about today. They're not recommendations, just examples of how people are starting to use the Wednesday-expiring option contracts. Now I'm going to talk about SPX index options. We've got multiple types and multiple expirations, so I've got a table where I'm going to break that down a little bit. Talk about why clients and customers out there have been thinking about and actually using very short-dated option contracts. When we only had expiration once a month, there were people that seemed to just show up for the last couple of days of each quarter. Well, now, each month. Now you've got the opportunity twice a week to implement the kind of strategies that you might want to trade when we're coming up on expiration. And I'll give some examples that have happened over the last couple of Wednesdays. Using the Wednesday Weeklys, we'll have plenty of time for Q&A at the end as well. So in the SPX arena, about 2 months ago, almost exactly 2 months ago, we introduced Wednesday Weeklys. Wednesday Weeklys, they're PM settled SPX option contracts, and we've had average daily volume, pretty strong average daily volume for something that's brand new. Yesterday was an expiration day. Actually, we did about 65,000 contracts or so. I believe our busiest day so far, and one of the reasons I like the Wednesday expiration is we get those FOMC announcements on Wednesday afternoons, and it's kind of nice to have options that are going to expire about an hour and a half or so after Janet Yellen and everybody has some commentary. We almost did 100,000 contracts of just the Wednesday expirations back on the March 16th FOMC day. Now this is what we have available now, and I divided these up into the traditional old school SPX options that have been around for over 30 years. They're AM settled, which means they cease trading on a Thursday and they settle based on opening prices on a Friday. Now, everything else, as I work my way across the columns, everything else is the same for all the different types of SPX options we have now. They're all cash settled, they're all European style, which I know institutions like not having to worry about early assignment. And ETH is the CBOE acronym for extended trading hours, which means these options, all of these contracts, actually start trading at 2 a.m. Chicago time. Now, we've had SPX Weeklys. A lot of people don't realize this, but we've had SPX Weeklys for, I believe, over a decade. Weekly options on stocks came out back in 2010, 2011 period. They really started to catch on, but we had weeklies on SPX available for several years leading up to that point. People started to pay more attention to the SPX Weeklys when they were paying attention to the individual stock weeklies as well. And basically an SPX Weekly is an SPX PM settled, PM Friday settled contract that settles on any of the non-third Fridays. And I'm going to jump around on this table for just a second. At the very bottom, we have SPX PM, and SPX PM is the same thing as an SPX weekly that expires on Friday, but it expires on the third Friday. So the third Friday of the month now, we have an AM settled and a PM settled SPX option contract. Now we have SPX end of month, which I think a lot of money managers like. We've seen some decent volume in those as well. And, if you're being judged at the end of each month by your clients, it's kind of nice to have options that match up with that time frame. Those are PM settled. And then finally, we added the Wednesday weeklies just a couple of months ago, and those are PM settled as well. And everything except for the traditional AM settled SPX options and the third Friday SPX PM options actually have a root ticker SPXW. And I know that the way that these options are displayed really does vary from platform to platform, but those are the 3 root tickers that we have for the available SPX index option contracts. Now, and there's the newest ones and the ones that we're going to talk about today. And more information about all this is available at that link below, cboe.com/SPX. Now, and here's just a list of what we had available as of April 4th. You can see we had 4 consecutive Wednesday expirations, several consecutive Friday expirations, and then we've got month-end expirations, and we've actually got leaps going out all the way to December 2018. There are, and in fact, at one time, because of month-end, I think we actually had month-end and a Friday and a Wednesday. We actually had March 30th, 31st, and April 1st as consecutive expiration dates. We had 3 daily expirations back to back, and all 3 of them were actually being actively traded. So why do people want to trade short-dated options? And one of the things that gets in there, especially for a lot of beginner and even intermediate option traders, is the fluctuation of implied volatility or the impact of time value. You might be dead on with a forecast for an underlying market, but a change in implied volatility or the impact of time decay might actually turn what you would have expected to be a winning trade into a losing trade. Well, the closer you get to expiration, the less of an impact time decay can have on long option contracts, and you can actually take advantage of time decay with short option positions. And what I did was this is a at the money SPX at 2000 strike call option. I think I used 12% implied volatility for this, and these are actually trading days to expiration. And I just used a Black-Scholes calculator in Excel and charted out, all else being the same, what sort of impact are we going to have from time decay. And one of the things that gets a lot of traders excited is this end right down here. The last 2 or 3 days leading up to expiration, you do see an acceleration of time decay. 10 years ago, you could do that once a month. A few months ago, you could do that once a week. Now you can actually try to take advantage of that sort of time decay when you get very close to expiration. Now, when we created weeklies on stocks, when we know something new is coming out, you try to speculate how people are going to go about using option contracts. And because of this chart right here, my expectation when weekly started to catch on for equities was that you're going to see a lot of option selling. Like you were just going to see people trying to take advantage of this at the money time decay. So I'd go talk to some of the market makers and some of the more heavily traded equities like Apple, and I actually was hearing that there was more buying coming into the exchange on the short-dated options than selling, which is something we didn't really expect. But what we started to see was in-the-money options that had very little time value trading, and I'll give you a couple of examples of SPX options. Like here's just sticking with kind of an average implied volatility. I've moved the SPX up to 2025, so you've got an option that's 25 points in the money, with a couple of days left to expiration, you're going to see in a trading example I'm going to show in a couple of minutes, this $1.60 is actually kind of it's kind of generous. You go farther to a 50-point in the money option contract, and with 3 days to go, you've got an option that's got time value of about 50 cents. You've got a delta for 3 days that's going to be very close to 1. And as the volumes for weekly started to catch on, myself and one of the other instructors at CBOE came across lots of examples of like block trades of deep in the money short dated options. And we're pretty certain that what was going on was people were taking positions, short-term, trading positions, and instead of buying the stock, they were using a little bit more leverage and buying short-term options that had very little time value that were going to replicate what you would expect to get, or very close to what you would expect to get from a long position or a short position in the underlying market. So there, and even just going out 15 days, the time value is not, relative to the overall premium, the time value of 750 is not prohibitive to think about going that far out. And in fact, I don't dig that far into it today, but we've seen 2 or 3 week options matched up with options that just have a couple of days left to expiration with calendar and diagonal spreads as well. So the time, or the nature of time decay and the nature of time value for very short dated options actually lends itself toward long trades and short trades, and actually seems to attract more long traders than short traders, which again is kind of a surprise to me. So some trades that I've come across, and needless to say, I was watching the Wednesday weeklies very closely on April 6th. That was an FOMC minutes day, and we usually get a pretty decent market reaction, either higher or lower. About an hour or so before the FOMC minutes came out, we had SPX at 2058, and I came across a block trade actually doing this. They were actually buying the 2055 puts for $1.80 and sold, I think this was a 1200 lot, and sold, I believe, 1200 of the 2060 puts, taking it a credit of $2.10. Now, this is like almost like a right at the money vertical spread. You'll see this on the payoff diagram. We've got a risk of 290 and a reward of 210. There's if you'd just gone long or short the underlying market, and there's where the SPX was at the time. It was very close to, kind of a long position with a profit target above 2060 on the close, and I'm trying to equate this to a futures trade and a stop at 2055. One of the reasons I like this trade, and like talking about it, is when the FOMC minutes come out, and I've experienced this in the past, you could get a really big gap move in the overall market, or a pretty violent reaction. So even if you were trading futures and you put out a stop order if we broke 2055, you're still in a very what we used to refer to as a fast market, when more was going on the floor, actually might not be as attractive. At least in this case, you can hold the position for a couple of hours through the close, and you know exactly what you're going to get on the close. And this trade turned out fairly well. The SPX April 6th close was up at 2066.66. Now, of course, the great Monday morning quarterback here is, well, we should have been maybe short the 2065s, short the 2065 instead of the 2060. But a very attractive short-term trade that you could do with options, and you know exactly what you're going to get on the close that day. So another one, and this one was actually early in the morning on Tuesday of this week. Today's Thursday. Tuesday of this week. And this one actually expired after the close yesterday on April 20th. But with SPX at 2100, a short-term, very far out of the money bear call spread came in. And the market has been strong for a few days. We were just topping over 2100. Somebody actually came in and did a day and a half, 2-day trade using the April 20th options again. They sold a couple thousand of the 2120s and bought a couple thousand of the 2125s. They only took in a dime, and there's a risk of 490, but they really have to be wrong for this trade to not work out. And I'm going to deviate some from the slides here when I talk about the results, because I took a look at the price behavior of the 2120 and the 2125s on yesterday afternoon as we approached the close, and something interesting was going on. Here's the payout at expiration, and this is the payout that was experienced yesterday. SPX was at 2100 when they put the trade on, and as long as the market was not up almost 1%, they were okay on this trade on the close yesterday, and we actually closed at 2102.40. Now, we did, I was watching that 2120 call, the one that they were short, and we did start creeping up to about 2110 yesterday. And even at the highs yesterday, if you started to get concerned about this trade, and it doesn't appear to me that they did this, but if they started to get concerned about this trade, they actually could have bought that short callback for a nickel. It was being offered at a nickel. And as we creeped up to, let's say that they felt like if it got up above 2110, maybe they should worry about a rally into the close, they still could have locked in a nickel profit on this. I know we're talking about very small dollars, but I'm also multiplying it times, again, a couple of thousand or so. So I kind of, not that I want to root against anybody, was kind of hoping we would approach 2120 and I would see what the cost would have been of getting out of the trade if we'd broken different levels. Luckily for them, I guess, it didn't get that high. And then finally, this is a trade that came in early yesterday. The market opened kind of unchanged. We were around 2100, and a short at the money bear call spread was initiated mid-morning. This was kind of a smaller trade that a trader I talk to every once in a while put on. It was actually their very first SPX Wednesday weekly trade, and they just felt like 2100 was going to be a top on the market. They turned out being wrong, but the trade actually turned out to be okay. This is one of those cases where somebody put on a trade, they were wrong, and they actually made a small profit. They sold the 2100 call at 430 and bought the 2105 call for $1.80, and they actually took in 250, which is, if you look at this as a binary trade, this is taking in 250 with possibly risking 250, and if the market doesn't move at all, they'd actually end up having a winner on this trade. So the risk reward on it's kind of interesting considering where the market was at the time. And this shows up a little bit better on this payoff diagram here, especially when you take a look at where the SPX was at that time. It was right at that spot where you would have realized the full profit of 250. As I mentioned, and we saw it in the previous payoff, they were wrong. The market went up, but it actually, and they did hold it through the close, they actually resulted in a profit of 10 whopping cents. So wrong on the trade, but was able to take advantage of a vertical spread that did okay and gave them a little bit of a cushion to be wrong. And then finally, and this is not a trade that I came across. I just priced some things out because I wanted to get an idea. I've heard from traders that with the margin requirement for an ES futures, for a mini S&P 500 futures contract, that there are situations that occur where you might be better off buying a call option, a deep in the money short dated call option on the S&P 500 as opposed to going long the futures contracts. So I took a look at early on Monday, like the first 5 minutes of the day on Monday. We had the S&P 500 at 2074 and the ES futures were offered at 2067.75. So let's just say you were bullish and you decided that you wanted to be bullish into Wednesday afternoon. We want to use an example that actually worked out okay. You could have bought the SPX April 20th 2050 call for $26.50. That's got $2.50 of time value in it. So there is a little bit of time value, but we're only 24 points in the money. So you could have gone deeper in the money and maybe put up a little bit more capital and had a little bit less time value. You also could have chosen to trade one of the S&P mini futures and purchase that at 2067.75. So I look at the use of capital here, and the use of capital is pretty interesting. You could be long that option contract, which costs $26.50. The margin requirement, and I got this from the CME's website. I know this varies depending on who your broker is, but the margin requirement on the CME's website was $4,500. So you've got a lower cost for an option that's basically going to move one for one with the overall market, as opposed to the margin for that mini S&P 500 futures contract. You also have a different multiplier. 1 point for the mini futures is $50. 1 point for the option contract is actually $100. So I took a look at when the S&P 500 was right at 2105 yesterday. I just wanted to find a nice round number. I assumed that you could sell the SPX 2050 call for $55. There's no time value there. That option's right at parity, and this was midday yesterday. The profit on that trade would have been $28.50 because you've got the 100 multiplier. If you'd gotten out of the futures contracts, you would have gotten the full 31 points, which comes to a profit of $15.50. So it's just it's something I'm still doing some work on. It's something we looked at in the past when we just had Friday weeklies, but we do see block trades that are deep in the money, calls and puts, and it often looks like maybe some traders have found a better use of capital by using deep in the money short dated options as opposed to going long or short the futures contracts. So with that, we've got Wednesday expirations, which means you've always got options that have about less than 3 days left to expiration. Yesterday, actually, I got that number wrong. We did about 75,000 contracts of the April 20th expiring contracts, and that's very common. On the Wednesday of expiration, whether there's an announcement or not an announcement, there seems to be a lot of trading going on in that final day. And then the time value, it's just creating some long and short trading opportunities, at least over the short term, that we didn't really have in the past. So the best place to get started to find out information on all the different types of SPX option contracts is the link there. And if you've got any further questions, if they don't pop up on the box or we don't address them, you can always use my email address as well.
Thanks, Russell. I've been asked to take a few minutes to show you some of the features and functionality in OptionsCity Metro for trading SPX options, and so we'll do that now. So what I'm going to show you on our screen here is the trade sheets in OptionsCity Metro right now, and you can see I have just set up a couple of months for the SPX outrights. I actually didn't put the weeklies in earlier this morning, but you can see I do have some value sheets for May and June, which were referenced in Russell's presentation. And specifically, I'm looking at the strikes in the middle, of course, and then I'm looking at on the left-hand side the call market data with my theoretical value that I'm generating in the pistachio type color there. And then the puts on the right where you see my cursor resting at the moment. And of course the at the money strike is shaded. So it looks like my values are mid-market here for the SPX markets, but I think it's important to point out that I can do linking of volatility skews. So if there's another market, maybe it's the spider options or the E-mini options that's maybe a little tighter and I want to generate my values from that, I can use a linked skew in OptionsCity. And specifically, if I wanted to look at my May skew here, overlaid between the bids and offers in the market, you can see that all my values are pretty much right in line with the electronic market. And if I look over here on the left on the inputs for what I'm using to generate this skew, this linked box is checked, meaning I am actually linking my, in this case, slopes and curves that I'm defining the skew from another product. So that can be the E-minis or the spiders, the common ones. But obviously there's a difference in product, whether obviously the expiration or even just general, supply and demand. I might need to put a volatility shift in or an underlying offset. So I do have that ability to put this in for a linked product. Why is linking these important, other than maybe because you think it's fundamentally the correct way to do this? It also lets you do less maybe skew maintenance throughout the day, and it's important, I think, as we talked about all the different weekly contracts with all the different expirations, maybe there's more to maintain, and it makes it a lot easier if you can kind of link things together. And it makes sense as well if you're sort of trading several index products on the S&P 500 in the same sort of basket and style and risk profile that we can take a look at in a little bit as well. On here, I can go in, we talked about, Russell defined one kind of spread trade. In here in my sheets, in addition to clicking on, a piece of market data and sending in an order ticket to make an electronic order and trade, I can also start pricing up a spread. So he mentioned the 21-25 call spread with, I think, the 21-20. So if I just click on these two strikes, I automatically in OptionsCity have defined, can instantly see what I have this call spread worth at 198 here. Obviously, if I'm in the SPX pit on a tablet, with just 2 clicks, I know the value and can immediately make a market in open outcry for this. Now, if I were to click on this spread, I can look at a larger view of it. I can maybe move the futures around and look at a hypothetical scenario of what this is then going to be worth. I could even lock in the futures price here if I were doing this as a laid up spread. I can also come in here, and if this is actually a cash spread that I'm trading the pit, I can come in here and say, we're doing this 500 times, what's it worth, and mark it as a cash spread. I think I hit the button wrong, but I think you get the idea there. Now, if I'm creating this spread on my tablet and I'm working as, I can put it in my list and kind of keep track in my hot list of these different spreads. So this defines it as this strange call spread quantity that I just created. And I can go into, and you'll notice if I click on 3 strikes, it'll define what the call put fly is worth. So if I priced up this put spread, I can then trade this from my tablet. So I can, this trade request button is to send an ETN to someone. I can see in here all the people I've sent ETNs to in the past, so they'll be saved in here automatically after the first time. So you can just card it up right there and send the ETN to them. In terms of accepting an ETN myself, I can get these by clicking this outcry button. A relatively new feature, and I know there's some people that are familiar with OptionsCity, or some customers and other people that are familiar that are logged into this webinar. You may notice this new piece of functionality in the 6.1 version, which is the share button. This actually sends the spread to a shared hot list. So if I'm trading as part of a group, now I have this shared hot list for everyone to see, so we don't all have to maybe card it up, or maybe I can make others aware of it in my group, or someone that's standing in a different area of the pit, or what have you. You will also notice that I do have my values in Greeks in here. If this is defined as an electronic spread already in the market, this will actually highlight in green now, populate with the electronic prices for the spread, and then I can click buy or sell right from here. This put fly does not exist, and neither does this call vertical, so I can't trade it, but the idea is that I can kind of use electronic trading of a spread from my sheets as a new feature in OptionsCity, even more so than in the past. I also have this number in here that I've kind of made bold and purple. This is a new value or Greek that we put in the system based on demand from our customers. We defined it as a delta tilt is what we named the value. It'd be commonly referred to as a normalized skew number, and so it kind of lets you know how much skew you could be buying or selling for any given spread price. So you'll notice that that is new in the system as well. Now going on from my valuation sheets, I mentioned the spreads and what exists electronically. We can of course access the entire, COB, HAL, SAL, and COA and respond to auctions in OptionsCity. But I did just want to pull up a list of here's the spreads, all the spreads that exist on the exchange for May, and you'll notice that I have kind of went ahead and ordered them by how many have traded on the day. So this put fly it's traded the most at 1,280 contracts today. It has my value overlaid between the market. Now I don't have to sort by volume necessarily. I can just define some as favorites, or maybe I just wanted to look at only the vertical spreads. I can do that as well. And then from here, I could, if it were the weekly contracts that that are able to quote electronically, I could auto quote these in OptionsCity. I could also run an electronic eye target finder mission for these as well. And I will show you that we can also have full access of the spreads that are trading in a time and sales view. So I can see, and these are the live markets as things are trading, that are letting me know what instrument traded. I happen to be blue or pink relative to show me if it was above or below my theoretical value on here. And what's interesting here is I can actually filter just for the spreads that are trading. And I can see that maybe something traded advantageously versus my values. I could actually come in here and generate an order ticket and reactively try to get on that trade as well. In addition to kind of linking SKUs for index products, I can also have linked and aggregated risk. And so I set up a quick example of combined. So I've combined actually E-minis and SPX into a portfolio view. So here is my net P&L. I've made some money. I'm short a lot of deltas. And if I wanted to look more into this, I could click on my delta and I can click on this and then see the breakdown between E-mini and SPX deltas that are giving me that net. And I have this set up in the background so that obviously there are different contract sizes, but I can normalize it. In this case, I wanted to look at everything. I can't remember how I decided to normalize it actually, but obviously the SPX deltas are 2.5 times what the E-mini deltas are. And I can even come and kind of break this down further. If I want to look on a month-by-month level, I can drop down and see where my deltas are coming from to make up that net total position. And that's just one quick example. I can do this for any Greek. I can look at position views that are normalized as well on a kind of strike-by-strike level to really kind of let you aggregate and look at both aggregate and separate kind of looks at your risk profile anywhere in Metro. And that's really kind of what I had together for this. It's really just a handful of things that you can do in Metro specific for SPX and index trading. We have a lot more. Obviously, we've had a large presence with the community here in Chicago trading these products for a long time, and we've definitely evolved the system along the way with several kind of long-term customers, and we'd be happy to get into this in more detail for anyone that's interested. And that sort of concludes what I have to say. I think there's a question that's popped up over there.
Mike sent us a question in the chat box, and he emailed it to me as well. Technology is wonderful. He was asking about the deep in the money options as a futures alternative, and noted that the dollar cost of those options is fairly high, and you can't dispute that at all. And just what might be a decent alternative, and I think probably the best alternative is always some sort of a vertical spread where you're selling one option and in order to help pay for the other option contract. We're not talking about an awful lot of time value here, but there is an awful lot of in-the-money premium for trying to do something as an alternative to trading the futures, like I showed in the very last trade. Just trying to spread it off one way or another is probably the best idea. I did look at when I priced out that in the money 2050 call, which was that last trade that I did. I did price that one out, and I took a look at if you sold the 2105 or the 2100 call at that time, and the premium was like less than $1, so it didn't even cover the time value of the option. So I don't know if that would have been a viable alternative at the time. If you're looking for more like just a 10 or 20 point move, which would have gotten you selling maybe the 2085s or the 2095s, the pricing might have been a little bit more attractive as far as reducing the time value and reducing the overall cost of the trade as well. So, a spread trade alternative, if shelling out $2,000 or $3,000 for a single option is not terribly attractive, is the short answer for all of that.
Well, if there's no other questions, that will conclude our webinar for today. As Russell had mentioned, you can get more information about the SPX options at cboe.com/SPX, and you can get more information about OptionsCity Metro at OptionsCity.com. I want to thank Russell for his time today and thank Pat for the demonstration. And we will have this webinar live this afternoon on our YouTube channel if you're interested in reviewing it further. Thanks again.